In today's low return, high volatility investment environment, traditional investments will fail to achieve investors' true goals of consistent inflation plus returns. Term deposits no longer outperform inflation, and so they'll fail. Similarly, Australian shares, while they may outperform inflation in a particular month or a quarter, they're very vulnerable to downside risk, and ultimately it's that downside risk that will lead investors to fail to consistently achieve their inflation plus returns. By contrast though, real return funds offer a shares-like inflation plus return, but critically, they also offer the opportunity for downside risk to be much more protected than in a shares-only approach. As a result, real return funds offer the greatest opportunity to consistently achieve an investor's goals. To achieve consistent inflation plus returns, real return funds require, as a starting point, all of the same investment capabilities that make for a successful balanced fund manager. However, there are three additional requirements that are necessary for a successful real return fund. First, they require peer-unaware asset allocations with much higher levels of non-share and non-bond diversification, often into the sort of asset classes that individual investors aren't able to access, such as local currency emerging market bonds or bank loans. Secondly, they require aggressive sector implementation strategies, whether it be long-short stock selection in Australian shares or a smart beta approach in global shares. Thirdly, they require the extensive use of dynamic downside protection strategies to ensure that the impact of downside risk is limited. These three additional requirements make real return funds even more demanding to successfully execute than that of a traditional balanced fund. Russell Investments offers three funds in its real return fund suite. Each of the three funds targets different levels of real returns after fees. The significance of after fees being that costs are Russell's problem to manage, not that of our clients. Each fund is designed to achieve its real return objective with much less volatility than that of shares. For example, in the inflation plus 4% net of fees portfolio, we're able to achieve the outcome with volatility of half of that of the Australian share market, materially reducing downside risk. And income-focused investors are also catered for, with the dual income real return objective of the inflation plus 2% portfolio. As with balanced funds over many decades, Russell Investments has also been a global pioneer and leader in real return funds. And there are four key reasons why Russell Investments has been successful in real return funds. Firstly, our global access to asset classes that frankly Australian investors can't themselves directly access, and even more importantly, our experience of combining them together to achieve a real return goal. Secondly, for each asset class, our open architecture ability to apply the best stock selection or smart beta solution, irrespective of whether that's within Russell or from a third-party specialist manager. Thirdly, we operate the world's largest fiduciary trading team. This means that all our equity protection and other dynamic activity can be implemented 24 hours a day for the sole benefit of our clients. Fourthly, Russell successfully manages real return funds for clients worldwide in London, New York, and Sydney. This ensures that our best ideas are reflected in all real return portfolios worldwide at all times, while customising those returns to maximise Australian dollars. Two notable active strategies in Russell Investments' real return portfolios are shares substitution and shares downside protection. These strategies are particularly important in environments like today, when both shares valuation and downside risks are both very high. In shares substitution, the portfolios invest in asset classes that offer share-like returns but with less risk. In 2016, high-yield bonds and Australian bank loans were key share replacement strategies. And in 2017 year to date, it's emerging markets local currency debt and bank loans globally that provide that share substitution. This enables us to reduce share exposures to around 1/3 of our overall real return portfolio. With regard to shares downside protection, within that 1/3 share exposure, both our US and European positions employ option protection executed by Russell's fiduciary team that ensures further downside risk protection. These types of strategies combine to enable our real return funds to target inflation plus 4% net of fees, with half the volatility of Australian shares.